For years, large capital expenditure plans were seen as a sign of confidence. When companies announced massive factory builds, new office campuses, expanded data centers, or aggressive infrastructure rollouts, markets interpreted it as strength. Big CapEx meant leadership believed demand would continue rising. It signaled ambition and long-term commitment. But in 2026, that pattern is changing. Across industries, CapEx plans are getting smaller, but smarter. This does not mean companies are retreating. It means they are rethinking how, when, and where they commit long-term capital. The first driver behind smaller CapEx plans is uncertainty. Demand cycles have become less predictable. Consumer behavior shifts quickly. Enterprise budgets can tighten with little warning. Geopolitical tensions and trade policy changes alter supply chain costs. In this environment, committing billions to fixed, irreversible projects carries higher risk. A massive upfront investment assumes stable growth. But growth today often arrives in waves, not straight lines. Instead of placing large single bets, companies are breaking projects into phases. They are designing modular expansions that can scale incrementally. A factory is built with room for additional lines rather than fully constructed on day one. A data center campus is developed in stages based on confirmed demand. This phased approach reduces downside exposure if market conditions soften. Interest rates are another major factor. When borrowing costs rise, the financial threshold for large projects increases. Capital is no longer cheap. Every dollar invested must clear a higher return hurdle. Projects that once looked attractive in low-rate environments now face stricter scrutiny. As a result, capital allocation committees are prioritizing efficiency over scale. Smarter CapEx means targeting investments with clearer payback periods, measurable productivity gains, and strong alignment with core strategy. Technology infrastructure illustrates this shift clearly. During the rapid digital expansion period, companies overbuilt capacity in anticipation of continuous growth. Data centers expanded aggressively. Hardware was purchased at scale. But when growth normalized, utilization rates lagged projections. Now, instead of building bigger facilities, many companies are upgrading existing infrastructure to increase output per dollar invested. They are investing in more efficient chips, advanced cooling systems, AI-driven workload optimization, and automation tools that extract more performance from current assets. Smaller capital deployment, higher operational return. Manufacturing companies are taking a similar approach. Rather than constructing entirely new plants, they are modernizing existing ones. Robotics, predictive maintenance systems, and AI-enabled production analytics improve efficiency without requiring enormous new construction budgets. These investments are focused, targeted, and productivity-driven. Why CapEx plans are getting smaller, but smarter also relates to supply chain resilience. Companies learned that concentration risk can be costly. But instead of duplicating massive facilities across multiple regions, many are building flexible supplier networks and forming strategic partnerships. Contract manufacturing, shared production capacity, and regional diversification reduce the need for heavy fixed investment while maintaining operational agility. Energy strategy plays a role as well. Companies are prioritizing investments that lower long-term operating costs and reduce regulatory risk. Energy-efficient equipment, renewable power agreements, and sustainability-focused upgrades may not dramatically increase capacity, but they enhance cost stability over time. Smarter CapEx aligns financial returns with long-term structural advantages. Investor expectations are reinforcing this behavior. Markets are rewarding disciplined capital management. Large, speculative expansions without clear demand backing are viewed cautiously. Shareholders prefer visible returns and operational efficiency over ambitious but uncertain scale. Strong return on invested capital has become more important than raw asset growth. Another important shift is technological acceleration. Rapid innovation cycles increase the risk of obsolescence. Investing heavily in a single technology generation can lock a company into outdated systems before full payback is achieved. Smaller, modular investments allow companies to adapt as technology evolves. For example, in AI infrastructure, companies are designing data centers that can integrate new hardware generations without requiring complete rebuilds. Flexibility protects long-term competitiveness. Board oversight has also become more rigorous. Directors are asking deeper questions about reversibility. If market conditions change, how easily can this investment be scaled back? What is the downside scenario? How exposed is the balance sheet? These governance pressures naturally favor smarter, staged capital deployment. It is important to understand that smaller CapEx plans do not signal pessimism. They reflect strategic maturity. Executives recognize that volatility is not temporary. It is structural. The goal is no longer to build the largest footprint possible. It is to build adaptable infrastructure that aligns with confirmed demand and evolving technology. Why CapEx plans are getting smaller, but smarter ultimately comes down to precision. Precision in timing, precision in scale, precision in expected return. In a world where change is constant and forecasting carries more uncertainty, permanence becomes expensive. Strategic flexibility becomes valuable. The companies that win this phase of the cycle will not necessarily be the ones that spend the most. They will be the ones that allocate capital with discipline, phase expansion intelligently, and ensure every investment strengthens long-term resilience. Because today, strength is not measured by how much you build. It is measured by how intelligently you build it.